We begin with Advtech, an education business that increased revenue by 8% and operating profit by 14%. Normalized earnings were up 16%, headline earnings per share also 16%, and the interim dividend per share 18%. A really strong set of numbers there, mid-teens growth in earnings, hard to fault. Now, if you dig a bit deeper, their results for the 6 months to June show that revenue growth, that was the 8% I referenced, was 300 basis points below the compound annual growth rate, or CAGR, from 2022 to 2026. Interim dividend per share growth was also strong at 18%, but below the CAGR of 23% over that period. Interestingly enough though, enrollments, that's student numbers, the lifeblood of the business, increased 13% versus a CAGR of 9%. So they ran ahead on student numbers in the past year versus their recent average, but there was a slowdown in the financial performance. Now, the group is growing very well and the metrics clearly look healthy, but the underlying revenue and earnings growth over the past few years has been particularly good, perhaps unsustainably good, as the group has unlocked higher operating margins. Now, those margins can keep going to a point, but they do have a practical ceiling. And that is exactly why the operating profit CAGR of 16% is so far ahead of that enrollments CAGR of 9%. This is the kind of thing that investors love seeing, by the way, because that's what you want, right? You want management to take a certain growth rate at the top of the income statement and turn it into even better earnings by the time you get to the bottom. But investors do need to be careful extrapolating that growth rate and assuming that a particularly high CAGR can continue, because it's very hard to just grow margins forever. You can't grow them to infinity and beyond. This is not Toy Story. They do reach a ceiling. Now, return on equity, 20.6%, also really good, up from 19.7% the prior year, increased from 18% in 2022. So with all these CAGRs, perhaps 2022 was just a very soft base. It was still a period in which COVID was relevant, so maybe it's just a cheeky year for the CAGRs. If we have a quick look, operating margin in schools South Africa was only 19% in 2022, and it's been over 20% each year since, having added 30 basis points in each of the past 2 years. So maybe it was just an easy base. Schools rest of Africa may really drive that point home though, because the operating margin is now at 30.1%, having increased from just 18.1% in 2022. Remarkable. It's also up 70 basis points year on year, so solid improvement versus 2025 as well. Tertiary is another strong margin contributor, with operating margin of 26.4%, reflecting a 50 basis points increase in the past year. It was down at 23.8% in 2022. So the point I'm trying to make is that using that CAGR, the way Advtech shows it in their results, may well be flattering the longer-term growth story at the business, because it does seem to have been a bit of a soft base. Take nothing away from management though. They've done a great job here of improving the business. But there is still an ugly little duckling, I'm afraid, and that is the resourcing business. This is something I've been writing about publicly for a while now. Operating margin just 6.8%. Now, that is better than the 6.5% we saw in 2025, sure, but it's still in a different postal code to the rest of the group. We're talking about education businesses banking operating margins in excess of 20 or even 30%, and here we have resourcing at 6.8%. Very difficult story there. And it gets worse if you actually look at the growth trend in revenue, because schools South Africa and schools rest of Africa both achieved revenue growth of 8%. Tertiary division was the absolute star of the show, with revenue growth of 17%, and remember that's also got good margins, so that's very nice for margin mix. But resourcing was very poor. It was down 15%, impacted severely by the closure of US aid in February 2025, and what that has meant for the part of the group that offers payroll and related services to multinationals operating in Africa. Advtech's resourcing business is actually far more than just a recruitment operation. Something else to just keep an eye on. Although the schools South Africa business is far more mature than the rest of the group, I'm watching the growth rate there in the context of the birth rate. Enrollments were up just 1%. Now, schools rest of Africa was good for a 14% increase in enrollments, and tertiary managed 19%. So you can see the schools South Africa business is mature. But the problem is that tomorrow's tertiary numbers are today's school numbers. The birth rate is driving serious questions around the attractiveness of education businesses over the long term. For now, Advtech is doing what they can. They certainly can't force or even encourage people to have more babies. They are rationalizing brands, they are driving efficiencies, and they are showing strong top-line growth, all of which is very hard to fault. It's just a broader concern around education over the long term. If there aren't a lot of kids running around, then who are we educating today and even tomorrow? We move on now to Italtile, a really tough story in South Africa, and credit to management here. They've done a fantastic job of keeping shareholders in the loop regarding the challenges of overcapacity in the manufacturing side of the business. Any pressure on throughput in manufacturing tends to have a nasty effect on margins, as overhead absorption just isn't running at the levels that it needs to. For context, capacity utilization was just 70% at ceramic industries in the year ended June 2026. That's obviously very low, and it makes it extremely difficult for them to generate good returns for shareholders. Sure enough, despite system-wide turnover being up 0.6% at Italtile for the year ended June 2026, group gross margin was down from 39.9% to 38.9%. 100 basis points is a material decline. Then we get to the real declines, a 10.4% drop in trading profit and a 9.4% decrease in HEPS to 113.4 cents. That puts them on a PE multiple of roughly 8, which still feels high for me given the underlying issues. So new CEO Brandon Wood does not inherit an easy story. He took the top job on 1 July 2026, so from basically the next financial period onwards, but he's already been in the job for almost 2 months now. And there is some refreshing commentary in the numbers here, or in the narrative, about areas where they still could have done better despite the challenging environment. I have a lot of respect for that. It's very easy to just throw your hands up and say, oh, it's all very difficult and South Africa is really hard and there's too much stuff in the market. But at least they are saying, hey, yes, it's very difficult, but we can still improve on certain things. It's nice to read stuff like that. I do appreciate it. But that doesn't change the fact that things have been hard. Net cash down 21% to 1.7 billion rand. And obviously, if that trend continues, then the business is going to struggle to keep up the dividend track record that it's had up until now. In the latest period, their capex ballooned from 234 million to 443 million. Share buybacks were 201 million and dividends were 1.8 billion rand. So we need to see an improvement in the cash trajectory in order for them to sustain, firstly, the share buybacks, and then if things really go wrong, even the dividend. Now, to their credit, they actually managed to increase retail margins by 0.5% despite negative volumes, which I think is pretty good. How do we know their volumes were negative? Well, if you look through the disclosure, retail store system-wide revenue was up 0.4% and average selling price inflation was 1.8%. That means that volumes must be negative as the balancing number because you have a situation where sales have gone up by less than inflation. Now, as for the manufacturing side of the business, it's much worse than that. Sales were down 1.1%, margins under lots of pressure, volumes down 4%, and despite flat sales in rand terms at Ceramic Industries South Africa, and even a bit of growth at Italtile, profit before tax for the manufacturing division absolutely plummeted from 538 million to 348 million. That's nearly 200 million rand down, and that explains the bulk of the group's year-on-year decline. That is because the retail division unfortunately just isn't much of a buffer here. It's facing its own challenges, with profit before tax down from 554 million to 514 million. About the only good thing I can say here is that the manufacturing side of the business is becoming smaller all the time. So as years go on, it actually affects the numbers less. But that is really fishing for a silver lining here. Import business also struggled, so again, not much of a buffer there either. And Italtile is actually considering a disposal of its business in Australia, which is part of the manufacturing side. Sadly, they discovered what they refer to as intentional manipulation of the results in Ceramic Australia, but no misappropriation at least. They recognized the negative impact of 7.6 million Aussie dollars. Perhaps more concerningly though, they had to put another 4.5 million Aussie dollars into the business in cash during the year to support it. That's obviously not what investors want to see. It's why Italtile is looking for a way out potentially. They're obviously looking to conserve their cash. Again, it goes back to that point around things like maintaining the dividend and share buybacks. It's hard enough in South Africa, but if they are also trying to keep a subscale little operation alive in Australia with all these kinds of other issues, it just stretches management way too thin. It's not worth it. It's the age-old story around offshore diversification versus diversification. At the moment, it's definitely diversification at Italtile. Now, in South Africa, will the provisional anti-dumping duties make a difference? They were introduced in July. We don't know yet, but one thing that Italtile does highlight is that they'll really only see a benefit once the overstocked positions have actually been reduced. In other words, there's just too much stock in South Africa, never mind new stuff coming in. Anti-dumping duties will help with preventing more imports or making them less desirable, obviously, but the market still needs to work through the current levels of inventory, and obviously that's the issue. And if you're watching this on YouTube, I've now put a slide up which just shows you the problem here. System-wide turnover has been such a sideways story over multiple years now. Headline earnings per share, downward trajectory. Cash generated from operations, very sideways. And then obviously your dividend flaps around a lot because they pay large special dividends per share. But if you look at the ordinary dividend per share, which is the one that management is trying to say to you, hey, this is the one we think we can sustain, look how that has also just tracked lower with everything else in the rest of the business. Really, really difficult story, and a classic example of the deindustrialization of South Africa that people are concerned about. Our manufacturing base is struggling. Plus, we have to deal with imports, which is made even worse by a strong rand. So what we're seeing lately with the rand is probably not going to be doing Italtile many favors at all. Then last update for this one, Sabvest. They've announced an investment in Frogfoot Holdings and Vox Telecoms. This is alongside other new proposed shareholders who will be putting capital into these companies. And by the way, this is fresh off the release of really good results at Sabvest. So they are on a high at the moment. It's quite a meaty transaction. Sabvest is injecting 754 million rand in cash for a post-money interest of not less than 8.97% in the companies. Very precise, I know. They are part of a pool consortium headed by a subsidiary of DNI 4PL Contracts Proprietary Limited, a name that just rolls off the tongue magnificently. And in the world of private equity, there are many different ways to build co-investment structures. So that's why you'll sometimes see consortiums, you'll often see co-investments, you'll see funny little minority stakes like these. It's not that uncommon. Now, this is a big business because with an enterprise value of 14.4 billion and an after-debt equity value of 8.4 billion rand, the Frogfoot Vox duo means business. There's also something in there called fibre that is part of the group. And perhaps the most useful stat to just keep in mind is that Frogfoot is the 4th largest fibre network operator in South Africa. But despite that size and despite the scale they've already achieved, Frogfoot and Vox posted a collective loss after tax of 256 million rand as at 31 August 2025. Now that is a very outdated set of numbers. That's not a typo or me reading the wrong date here. It's probably still loss-making. We don't know for sure. It takes a long time for these infrastructure-type businesses to actually become profitable. That's exactly why they need lots of growth capital so they can reach scale and then unlock the long-term economics of this thing once the network has been built. That obviously is what Sabvest is looking at here. That's why they are participating, as are the other investors, and it does look like an interesting transaction. It's a Category 2 deal, so Sabvest shareholders will not be asked to vote on it. But if the share price journey is anything to go on and the NAV per share growth over time, I think investors will continue to trust the Sabvest management team to make smart decisions with their capital. That's it for this episode. Thanks for listening.